So today I want to make an argument that I suspect will make some people uncomfortable, not because it is radical or extreme, but because it runs directly against one of the most powerful narratives in global finance right now. The narrative that says artificial intelligence is different, that AI is not a bubble, but a genuine technological revolution that justifies the extraordinary valuations and the extraordinary capital flows that have defined the technology sector for the past 3 years. I want to explain why I think that narrative is wrong. Not because AI is not a genuine technological advance. It is. Not because AI will not eventually transform significant sectors of the global economy. It will. But because the financial structure that has been built around AI, the investment flows, the valuations, the capital allocation, bears a structural resemblance to the dot-com bubble of the late 1990s that is so precise and so detailed that ignoring it is becoming increasingly difficult to justify. Let me start with the dot-com comparison, because to understand why the parallel is so alarming, you need to understand what the dot-com bubble actually was at its structural core. The dot-com bubble was not primarily about fraud. Some of it was fraud, but most of it was genuine enthusiasm for a genuine technological revolution. The internet was real. It was transforming communication, commerce, and information access in ways that were genuinely revolutionary. The companies that were being funded and valued at extraordinary multiples were working on real technology that did real things. What made it a bubble was not the technology. What made it a bubble was the gap between the capital being invested and the revenue that the technology could actually generate in any time frame that investors could rationally plan around. Billions of dollars were flowing into internet infrastructure, into internet companies, into everything internet adjacent based on projected revenues and projected transformations that were real in direction but wildly optimistic in timing and scale. Companies were valued at multiples of revenue that assumed continued exponential growth for years into the future. Pets.com raised $82 million in its IPO in February 2000 and was bankrupt by November of the same year. Webvan raised over $375 million before its IPO and another $375 million after it, built warehouse infrastructure across multiple cities, and filed for bankruptcy in 2001. These were not frauds. They were genuine businesses built on genuine market analysis. The analysis was simply wrong about how fast the addressable market would develop and how quickly the unit economics would work. The infrastructure was being built for a world that would exist, but would not exist for another decade or two. And in the gap between the world being built for and the world that actually existed, hundreds of billions of dollars of capital was destroyed. Not because the technology failed, because the timing was wrong and the valuations embedded assumptions about timing that proved to be fantastically incorrect. And if you are finding this analysis useful, please subscribe. I cover these structural economic realities every week because the gap between financial narratives and economic fundamentals is precisely where the most consequential decisions get made and the most consequential mistakes get embedded. Now, let me map that structure onto the current AI investment cycle. The AI technology is real. Large language models genuinely work. They can perform tasks that previously required human cognitive effort. They are improving rapidly. The potential applications across healthcare, education, legal services, software development, and dozens of other sectors are genuine. I am not disputing any of that. What I am asking is the same question that should have been asked in 1999 about the internet. What is the gap between the capital being invested and the revenue that can actually be generated in any time frame that makes the investment rational? And when you look at that gap, honestly, the numbers are startling. Microsoft, Google, Amazon, and Meta collectively announced capital expenditure plans for AI infrastructure in 2024 and 2025. That totals several $100 billion. The projected spending from the broader AI ecosystem, including data center construction, chip manufacturing investment, power infrastructure, and software development, is estimated by various analysts at between $500 billion and $1 trillion over a 3 to 5 year period. Against this, what is the actual revenue being generated by AI products and services today? OpenAI, the most prominent and commercially advanced AI company in the world, was estimated to be generating approximately $3 to $4 billion in annual revenue in 2024 against operating costs, including the enormous electricity and computing infrastructure bills I will discuss shortly that were substantially higher, producing operating losses that run into the billions annually despite that revenue. The entire commercially deployed AI sector, measuring all AI-specific products and services generously, was generating perhaps $20 to $30 billion in annual revenue globally, while simultaneously attracting hundreds of billions in investment. That is a gap between capital investment and revenue generation that is larger in absolute dollar terms than anything seen during the dot-com era at comparable stages of the cycle. The ratio of investment to current revenue is more extreme than what prevailed in 1999 and 2000 before the crash. The Nvidia parallel is the one that most precisely echoes the dot-com period. During the dot-com bubble, Cisco Systems was the most important infrastructure company of the internet era. It made the routers and switches through which internet traffic flowed. Every company building internet infrastructure needed Cisco equipment. And so Cisco's revenues grew dramatically, and its stock price reached valuations that were extraordinary by any historical standard. At its peak in 2000, Cisco was briefly the most valuable company in the world, with a market capitalization of approximately $550 billion. Then the dot-com bubble burst, and companies stopped building internet infrastructure at the frenzied pace of the bubble years. Cisco's revenue fell sharply. Its stock price fell approximately 86% from its peak and did not return to those levels for over 2 decades. Nvidia today is the Cisco of the AI era. Every company building AI infrastructure needs Nvidia graphics processing units called GPUs to train and run AI models. Nvidia controls approximately 70 to 80% of the high-performance AI chip market. Its H100 and subsequent chips have become the most sought-after industrial commodity in the world, with waiting lists measured in months and prices measured in tens of thousands of dollars per unit. And so Nvidia's revenues have grown from approximately $26 billion in fiscal 2023 to over $60 billion in fiscal 2024, and projections suggest further dramatic growth. Its stock price rose by hundreds of percent in just a few years, making it at various points one of the 2 or 3 most valuable companies on Earth. But here's the question that Cisco's history forces you to ask. What happens to Nvidia's revenues and valuation when the AI infrastructure build-out phase ends? When the major cloud providers have built the data centers they are building? When the chip inventory levels rise to match demand? When the next generation of AI chips begins to commoditize the market? Cisco's revenue fell by over 30% in the 2 years following the dot-com peak, and its stock price fell 86%. The infrastructure boom that made Cisco the world's most valuable company briefly also created the conditions that guaranteed its eventual decline from those heights. The AI infrastructure boom is creating precisely the same structural conditions around Nvidia right now, in plain view. If you have not subscribed yet, please do that now. The structural analysis I am building here connects directly to the valuations in equity markets, to the pension fund allocations that are weighted toward technology stocks, and to the capital allocation decisions that are shaping which sectors of the global economy get investment and which do not. The energy mathematics is the structural constraint that most AI analysis ignores or minimizes. Training a large AI model requires extraordinary amounts of computing power running for days or weeks, consuming extraordinary amounts of electricity in the process. GPT-4, to give a well-documented example, was estimated to have consumed approximately 50 gigawatt hours of electricity during its training run alone. That is roughly equivalent to the annual electricity consumption of 4,600 average American households used for a single training run of a single model. And training is only the beginning. Running AI inference, the process of using a trained model to generate responses for users, also requires significant computing resources for every single query. When you ask an AI system a question, somewhere a server farm consumes electricity to generate the answer. At the current scale of AI deployment, the aggregate electricity demand is already substantial. At the projected scale of expanded AI deployment with hundreds of millions or billions of daily AI interactions, the electricity demand becomes enormous. Microsoft, Google, Amazon, and other major AI operators are not just signing contracts for renewable energy. They are reopening shuttered nuclear power plants, investing in new nuclear capacity, and competing aggressively for any reliable power source they can secure in the quantities they need. The electricity demand of AI is projected by multiple credible analyses to consume a substantial share of new American power generation capacity over the coming decade. And here is the economic constraint this creates. Electricity is a cost, a large, growing, and largely unavoidable cost. When the revenue generated by AI products must cover not just software development costs and data center capital costs, but also massive ongoing electricity bills, the unit economics of AI service provision must be sufficient to cover all of those costs and return a profit at a price that users and businesses are willing to pay. The gap between the current cost structure of AI and the pricing that the market will sustain for AI services is one of the most important and most underanalyzed questions in technology economics right now. And the honest answer is that nobody has yet demonstrated that the math works at scale. Now let me explain what happens when an asset bubble of this scale deflates. History from 2000 gives us the template. The dot-com crash did not destroy the internet. The internet survived and became the most transformative technology of the early 21st century, creating enormous value. But in the process of the bubble deflating, it destroyed enormous amounts of capital. The Nasdaq Composite Index fell approximately 78% from its peak in March 2000 to its trough in October 2002. Over $5 trillion in market capitalization was wiped out. Hundreds of companies that had attracted billions in investment failed entirely, their assets sold off or abandoned. Hundreds of thousands of high-paying technology jobs were eliminated. The capital that had flowed into internet infrastructure at bubble valuations was written down. The fiber optic cable that had been laid across ocean floors sat dark and unused for years because the demand projections that justified its construction were wrong by a decade. The pension funds, the retirement accounts, the mutual funds, and the institutional investors that had allocated heavily to technology equities suffered losses that in many cases took a decade or more to recover. That is the historical template for what happens when a genuine technological revolution attracts investment at a scale and at valuations that the near-term revenue reality cannot justify. The AI deflation, when it comes, will not destroy artificial intelligence. The technology will continue developing and will eventually fulfill much of the transformative potential that is currently being priced into markets. But it will destroy capital at a scale that will affect ordinary people who are not paying attention to what is happening in their pension funds and retirement accounts right now. The capital that is lost will be someone's savings, someone's pension, someone's retirement security. That is what makes the silence on this question so troubling. Subscribe for more analysis of these structural, economic, and financial questions explained clearly and plainly. And tell me in the comments, do you think AI genuinely justifies current valuations, or are we watching the dot-com bubble repeat itself? See you next time.